Good morning and welcome to the Killik & Co market update. Inflation's everywhere these days, and a lot of the market's focus over the past few weeks has been around the ability for central banks to keep it in check. As we know, the classical response to tempering inflation is to raise interest rates, and it's this prospect and the potential consequences for some risk assets that's once again dominated headline news flow this week, as the US reported year-on-year inflation running at 7%, which, believe it or not, was as expected. It's also triggered an element of rotation away from those assets that were perceived to face headwinds in a rising rate environment towards those assets which have historically outperformed on a relative basis. A good example of these types of rotations or these types of companies might be a move away from the unprofitable tech sector in favour of the banking sector. And we can see this in action by taking a look at a simple moving average at an index level. So this table tells us the percentage of companies within an index that are trading above their longer term moving average. So as we can see, the tech-focused NASDAQ composite has only 29% of companies trading above their 200-day moving averages, compared to the broad-based S&P 500, where 70% of companies are trading above their 200-day moving average price. So interesting to note here that the Hang Seng is also still struggling somewhat on a broader trend basis. Here in the UK, the financial companies account for nearly 18% of the FTSE 100, and the index's exposure to financial, energy and mining companies have remained the primary drivers of recent UK large cap outperformance versus the US. And that's something that we can see here as denoted by the rising line, which shows us the relative performance of the S&P 500 to the FTSE 100. US earnings season is here and kicks off properly today with the likes of JP Morgan, Citigroup and Wells Fargo all reporting this afternoon, their Q4 numbers. As you may expect, given that banking stocks have been in favour over recent weeks, all three companies have run fairly well into today's earnings reports. So it'll be interesting to see not only if they can maintain that upside share price momentum, but also if they give us any insights as to the strength of consumer credit demand in the US. So for some context, as we head into these Q4 numbers, Q3 of 2021 was fairly strong, with around 70% of S&P 500 companies beating expectations on revenue and 80% beating on earnings. One interesting point noted by Bloomberg is that at an index level, analysts' forecasts for earnings per share, or EPS, for the S&P 500 in the fourth quarter have remained broadly unchanged for the past 6 months, at $51 a share. Now, this marks a bit of a change from previous quarters, where analysts have tended to increase their forecasts as we head into the start of earnings season. What this does highlight is an element of uncertainty amongst analysts as to the effects of the number of challenges companies have had to face over the past few months. So with the emergence of Omicron, rising input prices, ongoing supply chain constraints and wage inflation clouding the picture, trying to generate meaningful revenue and earnings forecasts has clearly been challenging. So some companies will likely have been able to navigate these issues better than others, and we'll find out who they are over the coming weeks. The UK economy is back on track. Data released this morning show that the economy grew above its pre-pandemic level for the first time in November. Economic output grew by 0.9% between October and November and was driven by momentum across all industries. The expectation was for a 0.4% increase, so this was a decent beat that takes GDP to 0.7% above its February 2020 level, which suggests that the economy has fully recovered from pandemic-related losses. Now, this data does predate the emergence of Omicron. However, there's a growing consensus that the impact of Omicron-related restrictions will only have a modest effect on GDP compared to Alpha and Delta variants. So we shouldn't be surprised to see a bit of a slowdown in December to January data, but hopefully the effects will be short-lived. With the US earnings season kicking off, the corporate calendars will be fairly busy for the next few weeks, but we'll be looking out for the likes of Rio, Goldman Sachs, P&G and ASML. That's all from us. Have a great weekend and we'll be back again next Friday.